Hey everyone, welcome back. Hope you're having an awesome day. Today is Tuesday, November 6th. I can't believe where the year has gone. It is just flying at us. We are running up into maybe Santa Claus rally. Who knows? Looking at the chart today, I was expecting a little bit of a bump, a continuation of the trend from last week. We're going to get into some of what's going on in the market. We're going to take a look at it. If you've got trade ideas and you want to see what I might be looking at, please let me know in the chat. Put your tickers out there. This is interactive. I don't have a script. I don't have like a thing that I'm going to show you today specifically, because every day the market is slightly different. I've been trading options for a very long time, so I can now look at the market movement, and I can kind of determine what tools I might pull out of my toolbox, so to speak, to utilize a range that might be profitable for a trade. So let's take a look at it. I would love to see your comments. I see we've got 6 people online. I already have 2 likes, so thank you very much for that. I very much appreciate it. And let's get into taking a look at the screen. I have Unity up here. I want to look at the SPX. This is a 1-minute chart, and we're just looking at what is going on throughout the day today. You can see we had a nice green candle to start the day. That was the great, nice strong green candle, and then we downtrended. We got just slightly outside of the VWAP. We had a move up, then we channeled down, bounced off the second standard deviation of the VWAP, kind of rode it down, broke to the downside. Now we're trading up on the inside. When I see this kind of price action, I often think that there's just a little bit of fighting going on between bulls and bears. We don't really know what's going on. We have to kind of look back at a bigger time frame and say, well, what is happening on a week-to-week basis? Last week we had an incredibly large move to the upside. 5% up the market went, came right back to these previous highs that we saw in the middle of October. And the question is, are we going to see another downtrend, or are we going to start trading sideways? And you can see on this, I've got these lines drawn on here that show kind of where my expectation was if we were going to trade in somewhere in this kind of consolidation period, looking for a breakout to either side. I keep reiterating my expectation is that we're going to see sideways movement to the end of the year. There's tons of reasons to kind of bet against the stock market right now, and I think we're just going to travel sideways, which is great. The only problem with that is the volatility index is also low, which means that the expectation is that we're not going to see a huge amount of volatility, and we are going to see this kind of sideways movement. We can track that on the S&P 500 by looking at the VIX. That's why I have the VIX over here. So VIX trading right now at 15.35. Historically, this is pretty low. If we look back at, this is a 1-day chart, if we just kind of scroll back through the last couple of years, this is COVID pandemic. We were up in the high 80s. Prior to that, we were sitting down here in these 12 levels. These are not great levels to be a premium seller in. Let me just turn off these pivots here so we can see a little bit better. What has happened is we've gotten some complacency in the market. We're just seeing, we have lots of information. We don't think the stock market's going to be rising a huge amount because interest rates are high. The Fed has been working hard to get those interest rates down lower. Last week, we saw a rise in the market, which meant that the volatility dropped. So we went from a period of relatively okay volatility when we're above 20 to now being at the 15, which is on the low side, and not a great place to be for volatility traders. I see GV, Graham is watching. He's one of my subscribers, one of my patrons. We were chatting this morning. I am heading to Vancouver tonight. I'm gonna get in fairly late, so I don't think I'm gonna be going out tonight, but I'm going to do that's why we're doing today's live stream today, Monday. We're doing the Tuesday live stream on Monday because I'm going to be on my phone tomorrow. I'm going to an IUR Capital free. It's like a sales pitch. I almost don't want to promote it for them, but I like the presentation that they do. I always glean a little bit of information off of it. Let me just pull up. I'm just going to pull up the IUR Capital website here, so you guys can take a look at what I'm looking at. I've been to one of the roadshows before. It's 3 hours. It is super in depth. What the type of trading that they do. They're going to be tomorrow. They're going to be in Vancouver. Oops, wrong button. We've got Los Angeles today, and then tomorrow Vancouver, Toronto later this week, Miami, New York, Montreal. So interesting, guys. The gentleman that is, his name's like Ryan or Ryan Gareth, something like that. He's the owner of the firm. They're from London. Again, from a complex options trading strategy, I like what they're doing. They basically sell a product, you buy into it. It's like $100,000 minimum, and they can kind of trade with you. It's an interesting setup. They use IBKR, which is one of the reasons I wanted to go see. They often, at the live show, they often have IBKR representatives, so you can ask questions if you have questions about that, which is fun. One of the most important things I think, though, is to just get together in general and kind of say hi. So if you're able to make the Vancouver 12 to 3 tomorrow in person, please reach out, say hi. I will be there with bells on. I don't know your faces, so let me know that you have watched my channel, and if you like my content or if there's something you want to see. And this is the right time to ask right now. If you're watching this live stream and you have a question specifically about a type of trade, anything, you're like, I want to know information about short puts. Now is the time to ask. Mike says, hi Levi, it's Monday, not Tuesday. That is so funny. Like, sometimes I feel a little bit like a robot with this kind of things. I get it. I have my streams Tuesdays, Thursdays. So I apologize for that. I must have said Tuesday, not Monday, and it is Monday. I'm excited to be heading to the coast because I am very excited about having some wings at the Charlatan tomorrow night. That's on the docket. I love traveling for food, and that's one of the things I'm excited about. Mike saying happy Tuesday, muscle memory. Yes, totally. Steve Lau, how do you manage the tax for complex options in Canada? Can you deduct the hedge cost from the profit? Example, the honey trap. So when IBKR reports, so I just use the IBKR reporting, all the commissions are taken like all the commissions are taken out of the trade capital. So if, say we start with a credit, like say I get a credit of $1 or $100, and then there's a commission, I actually would only report $900 or $99.35 would be what would be credited to my account. If I am doing a complex option and then there's a debit portion of that, then the debit portion is a loss because I am paying to open that, and usually it's expiring worthless in those cases. So all of that is taken into account, and we just have capital gains to report. And that's kind of how I do it. I mean, I keep it pretty simple. It's like I add up all my transactions that have happened. I see my capital gains. That's what I do. I hope that's okay. I've looked this up with the CRA before, and it's like, well, what do we have to report? What I'm reporting is how much I'm making minus my commissions, minus my debits for any of the hedges or anything like that. So if there's a cost, then I record it as a debit. And if there's a credit, I record it as a credit. I pay the tax based on that. And I do that through my accountant. That is all done through. So I have my transaction report, which is fairly lengthy at times. And I tracked it for years. I used to fill out every single credit and debit, and the IBKR reports match my bookkeeping perfectly. So now I just use the IBKR reports is what I do. GB, I was looking at Pfizer, PFE. They are past earnings now, and I was thinking it's been multiple years since they traded this low, perhaps a bull put spread. Okay, let's take a look at Pfizer. Now, one of the things I don't love about these companies is that we had this just massive uptick due to COVID. So when we look at the 3-month period here, where is the expected move? I don't think we're going to see a massive move to the upside in these companies. Pfizer is huge. If you look, where does it say on here? Stock data, company info. It's going to show doesn't show it. I have to look at Seeking Alpha. Seeking Alpha is a better way to look at these stocks just for those kind of things. Let's look at, I've got this on screen. I'm always looking for, potential things. One of the things I'm looking at are Bitcoin ETF strategies. I like BITO. It's one of the ones that I like. So it's ProShares Bitcoin Strategy ETF, strong buy rating. The dividends are an A+, which who cares about that? That doesn't make any difference in this case. What are the dividend yield is supposedly 16%. Wow, that's crazy high. But yeah, I'm taking bullish positions on BITO, mostly because when I look at all the ETFs, the BITO is the one that has the most volume, so it makes the most sense to do that. But we were looking at Pfizer, so let's take a look at Pfizer. And what I want to do is look at the summary. Here we go. Market capacity, $176 billion. Like, these are just massive companies. But if we look at the 5-year, which I think is important because we have to go back past the 2020 pandemic, we're going to see, where the valuation was. I'm actually surprised. Why did we not have such a big spike here? Went up to $34. That was the best Pfizer could pull out in the pandemic. I was going to compare to pre-valuation or pre-pandemic valuations, which looks like it was in the 40s. The growth is an F, profitability an A+, momentum a B. I agree with you, Graham. I think that looking at this at $31, based on its past valuation, like during COVID, we saw it down at 20. What kind of low did we at? $26, and now we're at 31. So we're at multi-year lows. If we look at the 1-year chart, we're down 36%. The profitability is key here. So we want to pay attention to how much debt load they have. But the fact that they are profitable at this point in time means that the likelihood is that they'll be able to continue to pay whatever debt they have. That is one of the things that we need to look at, is their financial statement, and find out how much interest they have and if their interest expense is increasing. Net interest expenses, like, nothing looks crazy. We don't, what I'm looking for is like some sort of increase. Here we go, non-operating income expenses. You see how this little chart is increasing? Unusual items. So these are the type of things that we have to look into. Earnings from continuing operations are also going up as the operating expenses go up. So is this okay? Our net income is good and increasing. Why is the stock going down so much? If it was a long-term hold for me, what I would do is I would dig into this a little bit more, and I would take a look. The dividend yield is also half decent at 5% right now. So there's a lot of things in here that are looking pretty positive for stock growth. There must be something in here that's a little bit negative, because I don't understand why the valuation is so low at $31. If I wanted to play from an options perspective, then all I have to do is set up options based on the expected move anyways. So I would just go over to Options AI for that. I could go out, we're 39 days out from the December 15th, which is the monthly end contracts. And you can see we've got a 29.33 expected move. So if I was going to play to the bullish side, I would put some sort of profit target in here, or I play something that was either going to make money if the stock stayed above $30 or 31, where it is right now, knowing that it only got down as low as 30. I would probably play this pretty aggressively, actually, depending on what is available. I just realized my IBKR is not open up, so I'm gonna have to put you on pause for 1 second while I get that loaded up. Just give me 1 second. Okay, thanks for that. So that is going to boot up, and we're going to take a look. In something like Pfizer, $31 stock, I mean, I would be tempted to just do this as a cash secured put or a ratio spread of some sort. Did you just crash on me? Oh, that's nice. I'm going to chat with them tomorrow in person about that. In the meantime, while I get that booted up again, why don't you guys tell me what else you'd like to look at? We've got John Lindsay saying, thoughts on a bear call spread, Roku 87.88. Again, I would go to, I'm going to turn those off. I would go to Options AI. Roku I don't play a ton. I have played it, and pretty successfully. I don't know why it doesn't stay in my regular rotation. You didn't give me any dates, John. Oh, like 3 weeks. Okay, there we go. So 3 weeks, expected move is 88.17 to 75. So the bearish position, I can see why you'd want to be bearish. We had this move to the upside. If we were doing the credit call spread, 82.89 gives you a 57% probability of profit. If we tighten this up a little bit, we've got the 86.89, 66% probability of profit, and you're asking for the 87.88. That's even further out. So there's the 87.89, 68% probability. I like your 87. When I see this 87 credit and then the 68% probability being at 68%, that's kind of the sweet spot for those. That's giving me enough out of the money. The question is, am I getting enough credit? $56 credit for $144 gain. Let's tighten this up one. Can we do that? Let's go one more. No. Yeah, it's gonna let us do it. 87, 80. Come on. Use the buttons. Yeah, it's giving me the 86 or 87.89. I would have to load it up in IBKR, and IBKR crashed on me. So let me try IBKR one more time. But that 87 seems like the right strike. I would agree with you. If you want a bearish position, that is the position I would be taking. Of course, not financial advice in any way, shape, or form. I don't offer that kind of stuff on my channel. One moment. Okay, sorry about that. And then we're going to get back to the live chat. So I would like that bear call spread. I like that in general. B-Baller, hi Levo, would you recommend selling options on futures? I like selling options on futures. I do complex trades on like ES all the time. My day trade today was on the NQ futures. It was up $450 just before we started this stream already. We've been range bound all day. I would actually like a little bit of a move to one side or the other. I just did some 112 trades. I did a 112 to the put side, a 112 to the call side, both expiring today. Collected $400 right out at the top of the day, and then we've had just kind of a non-moving day, and it has been making money. Steve says, got it. Thanks. You're very welcome, Steve. Lori, market is manipulated. Fundamentals don't matter as much as they used to. I couldn't agree more. I got stopped on speaking of futures, I got stopped on a futures last night. My stop loss was, I had the ability to put on, to fill outside of regular market hours. And it's like, it doesn't matter where I put that stop loss. It's like market makers are they just fill until they clear every single order out overnight. And if I had put it $5 higher, I would have lost $5 more. It bugs me to no end to have stop losses in place on things and to see them get like manipulated out and cleared out overnight. Can we do it in our favor? I mean, we can use that a little bit. If you're watching like what the volume is on specific contracts, we can kind of use that to our favor. But for the most part, there's a lot of market manipulation. There's something you guys should probably look up. It's called max pain. If you're looking for option trading, max pain theory. Basically, it's like where the most amount of investors are going to feel the maximum drawdown. That is where the market will move to. So it's a very interesting concept. I myself haven't actually traded with that specifically, but it's something that's fairly new to me in doing just a bunch of different research about like why the market moves into certain levels. And that was one of the more interesting reads that I've had as of late. And then there's a charting, I think it's called TDO. I've been getting a little bit more into looking at volume profiles and things like that because I think it's very important when we see the moves in futures, and I've been day trading futures quite a bit more. So because of that, I've been trying to pay attention to volume profiles a little more. Charles is saying, just filled a bear call spread on Roku, 46 days to E, the 95-100 strikes. John says, thanks, Charles. That sounds about right in that same, let's just look at that. Let's just go back to What did you do? 46 days to expiration. So that is the December 22nd. This is like right on the tasty expectation. We're going to do bearish. How do we get this to go here? Review trade. Why is that not coming up? Something glitchy here. Everything glitches out when we're in live mode, aren't we? It's amazing how that works. That's just gonna sit there and give me the spinning wheel of death. Okay, let's look at it on IBKR. So we're looking at Roku. I mean, it's all the same in the end, whether you look it up on IBKR or this is the 1 minute candle. So this is today. Let's look at the daily. You can see this pretty dramatic move. I'm assuming earnings came out last week because there's tons of people doing earnings. 95 is still in the recent highs. So we have seen the stock higher than that. We obviously saw it even higher back in 2022, which is a good reason to play credit spreads. If we go to the chain here, on Roku, let's look at the December 22nd, which is 46 days, and the 95 is going to give us 24 delta. So yeah, that's kind of right in that range. I've got this on. If I turn the strategy builder on, I can choose to sell the 95, buy the 100. This gives us a max loss of 500 minus whatever credit received. Typically, I'm trying to get around 1/3 to keep my risk reward ratio in check. Break even on this is 95.71. This is definitely a bearish trade, about 75 cents. And Charles didn't say how much he got, but about 75 cents is the credit to open it right now with a 78% probability of profit. Now, if there's other potentials with these trades, like if I was looking at this and I wanted to put on a how do we go back here? Can I just go back? No. Let me go back. There we go. So if I look at that Roku and I'm looking at the expected move and I'm saying, here we go, the expected move for December 22nd is $92. If I wanted to put on a trade that I was going to hold to expiration, I can build something that will make around that same $75, I'm pretty sure. That has some potential of making even more than that. So let's take a look at if that did come to fruition, could we get a little more money if it went to that move, the expected move of, sorry, what was it? I've lost my mind here. $92. So what we want to do is clear this off. I'm going to try to capture that move. And what I can do is that'll catch your 228. And then, so this will give us $1 to open. There's going to be greater risk, $800. That's only a $200 move. Let's try to reduce this and get similar credit to open. So in this case, 71 cents to open. If this was held to expiration, we have about $650 in risk on, so a little bit more risk than the $420 trade that was just the bear strategy. Collecting a similar credit. So this credit is the same if the stock stayed in this range or went down. So it's still a bearish trade. If it goes up and we want to hold to expiration, there's a chance of making $350. So there's this little bonus area. You can see the break even's 96.75. Now on the other trade, the break even was actually only 95.75 approximately. So you get another $1 higher break even. The probability of profit therefore is slightly higher. So just a different variation. This is where like complex options come into play if you don't want to do just a bearish trade. If there's a down move, of course, it's still going to function similarly. I mean, it's still bearish to the downside. If there's an up move, we have a different profit profile here. The dotted line functions a little differently. And at expiration, obviously, we have this much greater peak. So a little more risk for a little bit more potential. And the cool thing about these trades is you can just manipulate it a little bit. You can just say, okay, well, I don't want the profit 10 to be quite as high. Well, I've still got this break even that's still 96.41, so another 75 cents higher. But now my credit is even bigger. I'm actually opening this for around $1. So I've increased my potential to the downside, which is really the play. I think that the stock's going to go down. I have increased my risk though. So it is a little bit of a trade-off as to how you want to change these up. And again, reducing credit 75 cents, reducing the zone here, but increasing the height of the profit 10 drops my debit down again here. And you can just change these so much. It's a pretty fun little trade. This trade only collects 50 cents, but really tall profit tent. Risking $575. You can make almost a 50% return on capital if you hold to expiration and it ends up somewhere in this tent, which is a pretty small max range between 94 and 95. So it'd have to be a pretty specific move. But those are the kind of ideas that I like to look at when I'm considering layering on trades. So when I'm building out my portfolio, if I have, let's say I wanted to play Roku every single week, if Roku was my weekly trade, which it's not, but if I did, I might vary that strategy over time so that I'm like building these slightly different profit tents. Even if I was always bearish, I could just put on like a multitude of different bearish trades. Or I could, when my account is large enough and say I'm risking $10,000 per trade instead of $1,000 per trade, then I would layer on different strategies as well. I wouldn't just go all in on one. It's not necessarily like one optimal strategy. It's okay to have a wide variety of strikes to kind of smooth out that yield curve over time. So that is something to consider when we're looking at this. I would love to see some other stock tickers so we can look at some other ideas just like this. I think this is the fun part for me, is to go through these and look at them live with you and say, hey, what is it that we're looking at? So I know that these are intense little things. I've got 10 people watching and you guys are all like watching every mouse move. But if you have a ticker that you want to trade, pop it in now. And then I have my next question. I can go on to the next thing. Otherwise, I just have to scramble around. This is a bit of give and take in this type of live trading that I do here. AAL trading 1156 today, down 3.5%. This is right at the bottom of its range. I have puts at 1150 expiring this week, but looking at the stock chart on AAL, on these dailies, we've seen a lot of pressure over the last couple of months with interest rates rising. Are these companies getting to a position where they're oversold, and whether or not these prices are going to bump up? We saw quite the rally last week, and then now today a little bit of a pullback. I really expect companies like AAL to have a bullish move from these companies or from these prices. So these are the type of companies that I'm looking for. Not massive. I'm not saying I think that it's going to go back up to 19. I just don't think it's going to stay around this 1150 for very long. There's definitely opportunities in companies like American Airlines, Air Canada, United, which is UAL, a whole bunch of different ones. What else are we looking at? Do you trade SPX? Yes, Knowledge Seeker is asking, do you trade SPX? I do. I trade SPX. What do I have on? Right now, I've got some really basic trades on. I've got a little honey trap on, which is been on for a month, and I'm probably due to put another one on. So let's take a look at that. I tend to like jump all over the place. I'll trade like ES more frequently than I trade SPX, but I do prefer trading SPX over SPY because the options are cash settled. So if I was looking at a position like this and I'm looking at the daily candles and my assumption is that we're going to move sideways for the year, as I said at the beginning of this stream, but I'm also looking at this recent downtrend and the fact that we're right at the 200-day moving average. Oh, sorry, that's the 50-day moving average, right at the 50-day moving average. Could we see a bit of a drift down towards the 200-day moving average? Absolutely. So this is where honey traps work really well, where we can kind of target an area and say, well, what if the SPX drops down into this zone? Can I make money if it trades sideways here, anywhere in this upper zone, If we just trade sideways, can I make money? And can I make even more money if it drops down here? And this is my risk zone. You know, that's where I'm going to be building my risk, is below whatever level I pick. And this may be like 4,100. So let's take a look at SPX and go out to the December positions and look at a 45-day trade. So we're going to look at December 22nd, which is 46 days out. The VIX is a little bit low today, so not a fantastic day. The honey traps function on the lower side of the market. So we're looking for high probability trade, and we're looking for the maximum profit to occur if it drops down near that 4,100 level. So in this case, what I would do is I'm going to look at buying. Let's buy in here. So this is going to be a credit spread. So selling a credit spread on this side. This was 50-point wides. Can be pretty arbitrary, and you can change the dynamics of how this trade works quite easily. So similarly to that broken wing condor I was showing you before, this is a put version of a broken wing condor. So basically, if you've looked at any of like Ron Bertino's work, this is what IUR Capital uses. This is kind of their bread and butter, looking for a trade that gets open for a credit, $3.80, risking a certain amount of money. So in this case, 13,000 to make 1,200. It's 99% probability of profit. This is far too wide. So I wouldn't want to take that much risk. When I'm setting these up, I'm usually looking for like a 20% return on capital in the max profit zone. So in this case, we've got 6K, and this can make $1,000. So that is just slightly under where I want to be. So what I need to do is go a little bit tighter on this. Let's go to the 10 delta, which is a pretty extreme sell-off, and see what we can get here. So now we've got $2,000 of risk. We can make quite a tall profit tent, $950, and we're still opening this for a credit. We're getting about $90 to open this. So this profit chart shows that this is actually a losing trade if the stock stays here, but it's not. I mean, this is 4 puts opened for a credit. So if I get $90 today and all of these options expire worthless, then I get to keep that $90. So clearly, as long as the market stays above 41.10, I make $90. Now my max risk on this trade is going to be the width of the lower spread times 3 minus the width of the upper spread. So let's do that math. We've got 3 times 10, which is 30. So we're gonna have, if it trades, SPX trades lower than 4,000, we're gonna have to pay $30 debit to exit the bull put portion of this trade. If the SPX is trading that low, then this bear put portion, which is a debit to open, is worth $10. So we have a total cost to close of $20 or $2,000, which is why it's showing a max loss of $2,000. That's kind of where that math comes from. So this component right here, the 4,410 creates this point, that portion of the trade, and then the 4010 right here, or 4,100 rather, is the upper portion. And this is a pretty wide spread. This is actually 90 points. So from 4010 to 4,100 is the max profit range, where we would make around $1,000. It would basically be $1,000 to close this portion plus the 100 or $90 that we start. So the max profit on this trade is $1,090. Let's look at where that falls on the chart on SPX. So we're going to look at the 4010 and 4100 levels on SPX. So SPX, I'm just going to look in here, and we're going to go 1 day, and we're going to mark on here those levels. So the 4100, and then the 4010. So let me just load it in here. And are you gonna let me move that around? No. You can see I don't do a lot of this. only ever do this during the streams. Let me turn this off so you don't have to look at my face while I'm doing this struggle. There we go, 49. We're gonna put horizontal line there. So that would be the max profit zone. So if by some chance there's a sell-off, this zone down here, December 22nd, this is $1,000 profit. From here, it's 90 bucks. So we get 90 bucks if it stays above 4,100. We get $1,000 if it stays below here, and we lose $2,000 if it goes below. So that's kind of where the happening is. Let's just undo those. I'm going to do this in orange so we can see this is the loss zone. So this would be $2,000 if it dropped dramatically. But that's the kind of setup that I like to do on SPX, where there's no assignment risk. Relatively easy trades. We can manipulate those in many different ways, which is again why I'm a complex trader. It's like if I want to put $5,000 worth of risk on that trade, I just do it. Let's just go over here and see, well, how can we make this same trade really simply just $5,000? Well, all I have to do is widen out the leg here, and so this is 9,000. In order to be 5,000, I have to widen the upper spread here. So now we've got $7,000 in risk, and I'm lessening my max profit zone, but I'm reducing the risk by widening out this spread. This is still open for a credit. This is like, these are, glorified butterflies at this point. 4.6 risk, and we're at 5K. So there's the 5K trade. This trade could make 5K, could lose 5K. It's a 100% return on risk capital if the market drops down between 40.10 and 40.60 on December 22nd. If it doesn't drop that low, I still collect $140 to open this trade. So from a return on investment standpoint, if I was to take $140 credit to start and my total risk is $5,000, over the next 46 days, this returns 2.8%. We divide that by 46, and we get this daily, and we times that by 365. This is going to give us our annualized return, 22.2% annualized return. If we were to do this trade repeatedly every 46 days, risking $5,000 with the chance to make $5,000. So this is why I like this type of setup. It's still a bullish trade, but it is the type of trade that I like to take on SPX. GV, CAT is past earnings. Seeking it says it's profitable with a strong buy quant. Could be a bull opportunity there. What is CAT trading at? I love trading CAT. I have always been very successful with it. I've always taken a slightly bullish stance. I don't go super aggressive with it. It tends to be fairly range bound, and the premium seems to be there. So CAT is one of those ones I would consider, like even a poor man's covered call on something like this, or a zero extrinsic back ratio spread with a covered call. These could be decent returns on capital. So let's look at the 3-month. CAT has come down, trading at 286 prior. That is a seemingly large drawdown. So here's the daily. We're trading up at 290. We've come down past the earnings. We've had a little bit of a move up. Yeah, I definitely agree with you. Let's look at a bullish position in CAT. The IV is going to be low because we're past earnings. So if we go out to December, let's do the regular 39 days. I mean, I would be tempted to just do a really super simple bull put spread in here. Collect $1,000, got a risk of $1,000. It's a 47% probability. It's a straight bullish trade. That is one potential trade setup. Another way to do this is to do a zero extrinsic back ratio spread, which I'll show you. So it's a zebra trade. We'll do it on the calls. That'll give us a bullish position. We're going to buy 2 in the money calls. It's going to cost about $2,500 to open this trade. It's very similar to that bull put spread. I think at this point, I would like the bull put spread a little bit better. This has a slightly high probability of profit. The reason being is that there's a positive theta decay to this trade. Whereas the bull put spread is just strictly directional, this trade is actually has a little bit of theta because you've sold the short call against this. So you have a bullish position, the 2 times the 220 with the short 230, and then that 250 basically makes it so you're selling a covered call against it. If you were to look just at this portion of the trade, the call zebra portion, it's got a similar probability of profit of buying stock, 49%, with way less risk. I mean, the max loss you can take on this is the debit paid. You do have this value of death here. So if it did drop down to like 219, you would lose more than if you had just bought stock. So you kind of have to pay attention to those in general with these trades. But if you wanted bullish, you didn't have the money to drop down 24,000. You wanted to keep some of that cash making interest in your account, which it is making 5% a year right now. We can do this trade for a very, very small amount of money, about 10% of the capital outlay that we would require comparatively to buying stock outright. It gives us this delta exposure of 97.7. If you look right here, so it's similar delta to being long stock. Then we just sell the covered call against that. We now have a delta of 69. It's not going to go up quite as much because we've got the covered call in place. But if the stock doesn't move, we're going to be profitable on this because the decayed value from this 250 is going to decay to zero. So there's $250 in kind of extra money there, reducing the risk to the downside because we've collected a bit of credit by selling that covered call against it. And that's one of the trade ideas that I might have if I was playing CAT long term. The other thing you could do is the unicorn trade. Unicorns, if we say we thought CAT was going to trade between 230, 240, we could just go out to like May. We could buy in the money spread. So basically, there are 2 diagonals. This is going to give us a max loss of 5,200 is the max loss. It's a debit paid to open, and then there is a spread component to this between the 40 and the 90. We can adjust the amount of that max loss by adjusting how much the width of the second call spread is. This is like a poor man's covered call plus a call diagonal. I quite like them for stocks that just trade in a range. You can see the break even here, 223.99, 248. I haven't done this on CAT, but I do trades like this on Visa, and I feel like Visa and CAT are similar in their function, and the stock doesn't drop or doesn't move all that much. This is a positive theta decay making about $10 a day. It is completely delta neutral. You can see the delta is this slightly to the negative side, 0.03 to the downside, and profit tent that replicates a condor of sorts. We've got the faster theta decay of the options expiring near term compared to the lesser theta decay of the longer dated calls that we have for the 200, 270. So this is a trade idea that I might take if I was neutral and didn't have an idea that CAT was going to go up or didn't think it was going to go up. Again, we can adjust this. The reason I like these complex trades is because we can adjust these a little more aggressively. I can move both of these short calls up. What that does is it tilts the profit tent a little bit. So in this case, there's a bigger debit to open. We have way less risk to the upside. It's a more bullish trade. The break-evens are slightly higher now between 233, 264. If we look at options AI, we should really be seeing where is that expected move to the December 15th, 224 to 249. So if we were to look at this chart and say 224, if it is at 224, this is a losing trade. This is $700 down. And if it's at 249, we're right in at the very peak, $930. So this has that slightly bullish skew, and you can see that from the delta, 0.37 delta. If we look right here, so that has a 0.37 positive delta, bullish trade. If we adjust this back to the 230, 240s, now you're going to see that break even right at that 224, 248. So now the break-evens are what the expected option pricing is. This is a delta neutral trade. This is why I like these types of trades. So I'm utilizing the lower IV that makes it so it doesn't cost as much money to buy these longer dated in the money options. I'm buying a one in the money that's the bulk of the the funds. $4,600 is going into that. With the hope that it doesn't drop below the $200, obviously, because then I would be out whatever I've paid to enter this trade. A knowledge seeker says, I guess butterflies or iron condors might ideally for sideways movement. Yes and no. The problem with sideways movement in these markets is that the IV is low when we see this VIX level at 15, it's like there is no premium in selling condors. I actually think that similarly to this setup, let's just do it on CAT. Like, say we thought that there was going to be some sort of directional move. What can we do that might function a little bit better than a condor? This is where I might try to do some wide butterflies. And I would do them out of the money, and I would just try to open them for a small credit. So we could really simply just build some butterflies to either side. And I'm gonna just do that one wider here. And we could do we can just do straight up butterflies here. So I'm just gonna sell multiples of the short options. So there's not a lot of credit here. This is a credit of 15 cents to open, but the risk profile is going to be relatively small. We're getting 15 cents. This is like a limited loss Batman trade, which is because it looks like a Batman. But we have this very, very wide, high probability trade in here with these tall spikes. We can adjust this a little bit more aggressively if we want, just by widening out these strikes. So if we add a little bit of risk, and what we're doing is we're looking at the cost. In this case, I'm paying $40. I'm paying about $30 for the next leg. I don't think that's really worth it. What I think I would do is actually tighten these up in this case, and then sell more of the 210s. So I would do a 1-3-2 butterfly on these. So I'm gonna do 2. These are all just looking at the ratios of how many am I selling relative to how many I'm buying? Am I collecting enough credit? Well, now I'm getting 40 cents credit. That's better opening. So I get $40 if it stays in the middle. I still have about $500 risk, and I still could make $500. If we want to then take a little more risk to the downside, this is going to increase the amount of money that we get. Not a huge amount of advantage increasing it to the upside, but there we go, $1,400, $87. This is actually going to open for a credit of 134. So we get out our calculator, or we do it in our head, and we say, what if it stays in the middle? What if it doesn't move? And I hold to expiration. If I open this for credit of 134, then so I have the inside line, this portion right here. What is that worth? We're going to be 134, and then we're dividing it by the total risk, which is 1,400. So this is not a bad return on investment at all. It's 9.5% divided by 46 days. Times that by 365. Annualized, if you did this all year and it always fell in this small profit range, you make 75% return on capital. There's a chance it could run up into one of these bad years. These types of trade do like to be held to expiration. So this is the type of thing that I'm looking at when the IV is low, where I feel a little more confident holding closer to expiration, as long as it's somewhere in the range. Ideally, it runs close to the ear. If it just ran right here, stock was trading right there, that would be awesome. I would be able to get a very nice credit to close this, and I wouldn't be worried so much about zipping over to max loss. So that is the kind of setup that I like in low IV, or at those unicorn trades that I showed you before, that poor man's covered call, which I set up, which had the two multiple diagonals, but they're all the same kind of thing. You're picking a range and you're picking your direction. Butterflies can be very directional. Okay, let's see. Mike Mueller, can't wrap my head around this. Let's say you have a stock will rise to $100. Between the two, are you better off buying a 100 call or at the money? Okay, Mike, tell me what is the stock? Give me like a real situation, and then let's do a comparison, because I'll show you in my comparison calculator. I think that when we look at the expiration value in the comparison calculator tab of my rolling options record keeper, we can really analyze the two different positions. So if you pull up a stock and whatever stock, you must be thinking about a stock that you think are going to rise. And then we'll look at the buying the call. We'll look at buying an at the money call. And I think we should actually compare Zebra as well. I think that those are all good comparisons. We're 1151. We can do this. You just let me know what stock it is that you want to look at. And I will pull up I'm going to pull up the record keeper right now, the record keeper tab, so we can take a look. And because I think that this is important to exercise, and I'll show you why I use my software the way that I do, or why I've written my rolling options record keeper the way that I have. So we're going to look at this. I'm going to pop this open. Autodesk, you're going to give me a knowledge seeker says, thanks a lot. You're very welcome. Mike, I'm still waiting for you, but I think you're probably just listening to me now, because I know there is a little bit of a latency with these streams. So in the meantime, what do we have that's around $100? Let's look at my list here. Let's just sort by. So $80, IBKR, hilarious. Enphase. Let's look at IBKR. That's a slightly bullish position. So we'll look at IBKR. There's enough option premium on here that we can see what is going on. Say I thought that IBKR was going to go to $100. That was my assumption. Well, there's a few things I can do. So the first thing I can do is just buy stock. So we're going to pull this up. I'm going to type in IBKR, and this is going to pull up the share price, but it's not going to because I have mine overridden. In your copy, it will. We're trading at $80. We've got long shares. So we're just going to say, what if we own long shares? And we're going to purchase 100 shares. So this is going to be a debit, right? Debit of $80. So we got $8,000 in this trade, and this is what the profit profile looks like. So if the shares go to $100, we're actually off the chart. So let me widen this chart just a little bit. So if we went to $100, we know that we would make $2,000, okay? Because the share price has gone up to $100, and we bought $8,000 position. It's now worth $10,000. Now let's look at the long call. So if we're looking at IBKR and we're looking at the December 15th, now the cost of buying the call is going to be, the at the money is going to cost $3.10 or $300. The profit profile is going to have a delta of 57. It's going to have this delta that increases. The more IBKR goes up, the faster this delta becomes close to 100. The max loss is $310 in this case, and we have the 80 call. So let's take a look at expiration and compare this. So we're just going to go in this one. We're going to say custom. I don't think I have a long call position in here. This is going to be minus 310, and we're going to buy a long call that's the 80, and not going to buy shares at all. So you can see now where the difference is. If we bought shares, we have way more downside risk if the shares go down. Buying the long call, the most we can lose is the cost of the call, so $310. But if it goes to $100, we don't make nearly as much money. $1,700 compared to $2,000 because we had to pay that $300 premium. So we can still get a bullish move. Costs us way less money, way less risk. This can be very, very lucrative to do this. Now let's look at a long call. We'll just do another one here. That is a long call at say 100. How much money are we going to make if we bought the 100 call? Now this one is going to be only 15 cents. A very, very, very small risk, but we could make some money. Let's see how much money we can make. $15 this is going to cost us. So minus 0.15. In this case, if it goes to $100, we actually are just at our break even. If it goes to 100, we're still losing money actually. So a far cry. This shows us that if we are very bullish, what we want to do is buy calls that are further at them or closer to at the money, because they're going to have a greater delta. If we look at IBKR here, the delta is just really low. It's 0.03. So it's not a very directional trade. The further down we go, the more delta we're going to have. So in this case, let's look at if we bought the 70 call. And this is going to cost $11.30 to open. What this is going to do is replicate stock very, very well because it has a higher delta. Now I don't love buying long calls. It's not my favorite thing in the world, but minus $11.30 to buy this guy. Here we make very similar to buying stock comparatively to the long call that was at the money, but on the downside, we're taking more risk. So there's greater potential because we're paying less extrinsic value for at the money than for the at the money position, but we're also taking greater risk. Somewhere around this zone is where we want to trade. Not the 100, not the out of the money, not where I think that it's going to go, because that trade isn't really making any money. Zebras are an interesting thing. Let's pull up a call zebra and call zebra. So this is going to, I'll walk us through the whole thing here. We're going to look at, I'm going to clear this off. We're going to buy 2 of the 75s. And then we're going to sell an 80. And this is a call zebra. It's going to cost $10.40. So that's the max risk is $10.40. And it's going to have a very, very high delta. This has 104 delta, which is exactly the same as owning stock. So 75.80, and we're paying $10.40 debit to open this. So let's go back to our comparison. So the option expiration is going to be 12.15. We're going to, the short call is going to be at 75, sorry, 80. And then the 2 short calls are at 75 and 75, or the long calls are at 75. Short call at 80, 2 long calls at 75 for a debit of 10.40. And again, very close to replicating stock. This is as close as we can get. This is why it's called the zero extrinsic back ratio spread. It's giving us no extrinsic cost to own this. We're basically buying an at the money call. We're financing it with the 2 short calls. That's what's happening. We're selling a short call at the money, and we're buying 2 long calls. The extrinsic value that we're paying for the long calls is being offset by the extrinsic value being collected by the short call. And the short call is at the money, so it has greater extrinsic value. It's the valley of death that we have to worry about, and that's this right here. The max loss is 10.40. So if you're super bullish and you really think that the stock is going to go up, this is a fairly low risk trade for quite a high reward, just buying the call outright. But if you're wrong and the stock doesn't move, you're out $300. This call zebra has more value, a greater cost to open, and it has greater risk. But if the stock doesn't move, you're not out any money. You lose like $40 on this trade as opposed to 310 if you're wrong and the stock doesn't go up. Where the risk is if the stock drops down to 74. So it's a trade-off. Dr. Jim on Tasty Trade says for every gimme, there's a gotcha. That's the thing. Okay. You guys are awesome. It's 12 o'clock on the nose. Been fantastic. I appreciate it very much. I'm pushing that button. I'm going to see a few of you at the IUR Capital Roadshow tomorrow in Vancouver. If you missed that, go back at the beginning of the stream. I talked about it. Every one of my patrons, I will see you on Thursday. We're going to do the portfolio review, look at the weekly summary. Just killing it. I'd be like, I had 3 weeks in a row of 100% wins. $1,000 a week on target for the last now 9 weeks in a row. Just everything's working tickety boo. So hopefully you guys are having those same sort of results and using strategies like I'm showing here today. Steve, thank you so much for saying I'm awesome. I really appreciate that. You guys are great. Take care. Bye.